If at all during the presentation you've got any questions or comments, please type them in. For those of you who are familiar with me, I do like a bit of an interactive webcast. It can be a little bit lonely just talking to yourself. And I'm a little bit more of a riffer, so it's good to kind of interact with people. So please feel free to ask any questions you have about the market or what we're talking about tonight, and I'll do my best in answering them. To be honest with you, some of them might be best answered in the second part, which is actually going to be more focused on a trade group style, where we go through the market, we look at different stocks, give opinion on stocks. So if there's any stocks that you want us to look at, type them in and we'll actually look at them closer and show you how we analyze them in the next second part webcast. But tonight is about the basics, right? So let's get stuck into it, shall we? So you might be wondering who we are. For those of you who are new, we're Trader Circle and Emerald Financial. Now, Trader Circle's been around for about 15 years. Emerald Financial, a couple of years. It's a sister company. Trader Circle's goal is to basically support traders. So we're traders and we want to support other traders. And we do that through a number of ways by providing full service, but also providing education and resources as well. Emerald Financial, on the other hand, is a little bit more longer term. It's more about investors, medium to longer term investors. It's about stock picking in the long term and that type of thing. And so that's more recent to our business, but still very rigorous. We've provided calculators and screeners, some of the best screeners in Australia. So if investing's a little bit more your thing, then Emerald Financial will be able to provide some very rigorous services for you. Whereas if trading's more your thing, then Trader Circle is the place to be, basically. Now today, I did allude to it earlier, and for those of you who are joining us tonight, you probably already know, there are a few things we want to cover. First, I'm going to go into the foundations that you need to have in order to be a successful trader, right? I mean, that's pretty good stuff to know. I'm going to go through a little bit of technical analysis because we believe that is extremely important to know when you want to be a short to medium term trader. Trading strategies for different market conditions, which makes sense to have if you're trading and you want to try and take regular profits. And common rookie mistakes, right? Some of them are going to be fairly obvious, but it's good to reiterate them. And some of them you may not have thought about. Now, I'm not going to do a whole section on rookie mistakes, but they'll be kind of plotted in as I teach the other stuff, okay? Glenn, I can hear you. I'm hoping the rest of you can hear me. The fact that no one else has said that I'm not being here hopefully means that you guys can still hear me. So again, Trader Circle was established in 2005, and the purpose of us is to support traders. We became one of the busier options trading desks in Australia, and we do run courses for beginners right through to seasoned traders. Now, our courses are somewhat of a stepping stone, really. We don't really want to trade for you. In fact, as a trader, that doesn't really work, we find. Investing is a little bit different. So, there's managed funds out there that are successful, no doubt. But from a trading perspective, trading is much more risky. It's much more complicated. And the individual really matters in terms of their risk preference, right? And so we don't want to trade for you. We want to give you trade ideas. We want to support you. We want to help you as much as possible. But ultimately, we want you pulling the trigger and understanding what's going on. And so, we need to give you an avenue for that. And that's why we run trading courses. We only run a couple or a handful of trading courses that are designed to teach you an array of things, right? You can do just one and be successful, or you could do all of them if you want to cover a few different bases, right? But I don't want to go into our courses tonight. That's not really what tonight's session is about. If you do want to know more about our trading courses, then you're welcome to give us a call, have a chat to the education department, which is who the head of that is, Jared. You're more than welcome to organize an appointment with him to kind of discover how we might be able to help you learn to trade. I think I've basically explained this, but our method is to teach you how to trade. And then what we want to do is provide you the support, the tools, the trade ideas, and hold your hand as you transition to live trading the market. My name is Cara Cornup, so probably should put this slide at the start. I'm an advisor who sits on the trading desk. I've been with Trader Circle for 8 or 9 years now, and I'm also the head trainer. So with all our courses, one of the things that really separates us from other businesses out there and other providers is that you actually get your own personal trainer. And I kind of oversee that. That's my job. I've been training and educating people for a very long time, which is, I think, a skill set that I've developed. And it's the reason why I can run these webcasts, hopefully, and teach you something tonight. Before I get into the guts of it, it's really important to understand that any advice contained in this presentation is general only, which means it's not tailored to your personal circumstances. It therefore means that you need to decide for yourself as to whether this advice is appropriate to you. And that really goes for all of Trader Circle. We don't give personal advice. We won't give statements of advice. We won't look at your tax and all that type of stuff and go, hey, you as an individual in your circumstances should do this type of thing, right? That's not what we do, right? The advice that I give to you tonight is the same advice that I would give to anyone, right? Regardless of circumstance, okay? Now, I mentioned that it's probably good to start with knowing, what if you are a beginner, which I assume a lot of you are, what are the things I need to learn? And there's a lot of stuff. There's a lot of stuff you can learn out there, right? It's kind of good to group these things to know what you need to tackle. And we've, if you go to our YouTube page, and like and subscribe and all that nonsense. If you go to our YouTube page, there's videos on there that of past webcasts we've run where we've really drilled into this stuff. We've run a three-sectioned webcast. A three-part webinar series, sorry, is the best way of saying it, just on this stuff alone, right? But if you did want to be a successful trader, then we believe that the three main things you need to focus on is the ability to pick direction, different strategies, as well as risk management. And I am looking at this from the lens of a trader, right? Not necessarily a long-term investor, right? And what brings all of these things together is a set of trading rules. And this kind of comes across, this kind of brings me to the first rookie mistake, which is that people who are new to trading don't have a set of trading rules. And if they do, they don't stick to them. Or I should say, they're not tested. So that's something very important to think about if you're new to trading and you're kind of starting on this path. Despite the fact that you have to learn to pick direction, you need to have different strategies for different market conditions, and you need to be able to manage your risk effectively. Despite all that, you also need a set of trading rules that you not only have the discipline to follow, but also that have been tested, tried, and you have the ability to amend to the current market conditions. Now, those trading rules can be really tight, where you need kind of like all the stars to align before you enter a position, and that's totally fine. But they can be fairly loose as well, right? And it kind of depends on the type of trader you are. It depends on the risk tolerance, depends on how much experience you have. And there's a lot of things that will really affect those, okay? If you come and do a course with us, we'll actually give you the set of trading rules that we use. I myself have a slightly different set of trading rules because I've got a lot more experience. And it's the same with the other advisors on the trading desk. But what we're going to do is we're going to give you a fairly conservative, tight set of trading rules that we think is great for beginners. And then as you gain experience, you can amend those to suit you as an individual, which we encourage you to do. And we can help you do that as well, okay? The reason why trading rules are great is because, well, I think it's obvious why they're great, but ultimately there's a lot of stuff out there, isn't there, right? You can see the little Wall Street bet logo there. That's become very relevant over the last 6 to 12 months, hasn't it? There's a lot of different news sources out there. There's politics, there's technical and fundamental analysis, there's news, there's market forces, there's Jordan Belfort style boiler rooms out there. There's a whole bunch of things, right? And you need to be able to bring that down into and boil it and distill it down into a set of rules, basically, right? Create an orderly fashion. And the reason why they're important is because ultimately rules help keep you disciplined. They'll help reduce stress levels, which is part of managing psychology, and that's extremely important. It help simplify your decision-making. It keeps the approach logical rather than, say, emotional. And ultimately, it's about managing psychology. Now, for those of you online who have a bunch of experience, you'll understand that psychology is actually the majority of trading. When I first started 10 years ago or whatever it was, might have been a bit longer. Yes, my mentor, Carlo, he said to me, trading is like 80 to 90% psychology. And that didn't really resonate with me back then. It wasn't because, it wasn't because of my age or anything, or naivety or anything like that. It's just very hard to understand as a beginner. But experienced people online, I'm sure, will agree with me that a lot of trading is, if not majority of trading, comes down to your psychology. And having a set of trading rules, especially as a beginner, really, really helps sort that out. Won't remove it completely, God, no. But it certainly helps. So I think if there's anything that you took away from tonight, it's this stuff here that I'm going through right now. It's the fact that you need to be able to pick direction, have a bunch of strategies, manage your risk, and bring them all together into a set of trading rules, right? If you left now and that's all you took away from it, then I'd be fairly happy. Right, now, it's technically, or theoretically, there's two types of analysis, right? I think there's three, but when you go Google, there's only two, right? Which is fundamentals and technicals, okay? You've probably heard these before, but if you're a beginner, I'll just quickly, briefly explain. Fundamental analysis is actually suited to more medium to longer term investing, right? Should a short-term trader disregard them? No, I don't believe so, not completely. As a beginner, as a short-term trader who's a beginner, I think, yes, you should ignore them. But as you gain experience, you need to, I believe that you should actually start introducing fundamental analysis into your decision-making process as an experienced trader, personally, right? That being said, if you just do technical analysis and that is working for you, well, don't fix something that isn't broken. That's a really good mentality to have as a trader, in my opinion. But fundamental analysis is predominantly used for medium to longer term trading, and it should be incorporated somewhat into your short term trading as well. And as you can see in front of you, it basically looks at the company's balance sheet. It looks at the sector that it performs in, the economy as a whole, right? And how that might affect future price movements. What was the company's report like? Are they profitable? What's their future earnings like compared to what their current share price is? What's their price to earnings ratio? What's their future guidance? These are all part of fundamental analysis. And it makes sense that that's good for longer term investing, right? You want to invest in a healthy company. Yeah, for me, that makes a lot of sense. Technical analysis, on the other hand, is it's actually really quite interesting and really quite unique. Technical analysis is the study of past price data in order to predict future price movements. Now, we could look at past price data, so what the share has traded at over time on a spreadsheet if we wanted to and go crazy, or we can put that into a graph, which is also known as a chart. So technical analysis is basically the study of charts. Now, that can also include cyclical analysis or seasonal analysis, right? Where you look at, during Christmas, there's a Santa Claus rally. During Easter, mind you, there is one as well, typically, and we're actually going through that right now. In May, you go away, that whole saying, right? After the April rally, it's a bit of a fall. Technical analysis is about studying past price data, right? And it's about looking, if the idea is that history repeats itself, essentially. And I'm going to go into technical analysis a lot more tonight, and we believe this is much better for short-term trading. The third type of analysis is called pub analysis, and it's when your mates tell you to buy something. Now, I put this in as a bit of a laugh, right? But I mean, come on. I mean, we've all been there, right? We've all been at the pub, out to dinner. You meet someone perhaps new. They find out that you're interested in the market and they tell you to go buy something. And, fair enough, right? To be honest with you, I'll always listen to what someone has to say, right? Of course, if someone says to go look at the stock, I'll 100% go look at that stock. But my analysis certainly doesn't stop there, right? Your analysis needs to be a lot more rigorous than someone telling you what to buy. And that includes us as well, by the way. If I say to you, hey, I think Fortescue is a really good stock, which I do believe that, by the way, as a bit of a tip for you guys. Don't just go and buy Fortescue. Go and actually do your fundamental analysis or your technical analysis, right? And go and do it, right? Don't just listen to your mates. An example where pub analysis kind of fails is through hype, right? And I do just want to slot this in here. This is another rookie mistake, right? This chart's awesome. I've seen this chart, this template, if you will, play out time and time again, like numerous times. So I'll let you kind of look at that, right, and read what's going on there. This is the kind of classic penny to small cap kind of play. Now, sometimes they work out, don't get me wrong, and I'm going to show you an example in a moment. But the idea is that if you kind of just jump on the bandwagon, chances are that the people who are smart are the ones selling to you, which means you're being left with you're holding the bag. And a good example is this brain chip company that some of you might know. Now, back here is where the hype happened. Yeah, and you can see. I mean, it's not. If I just I just want to flick back and forth between. Can you see how it doesn't look too dissimilar? Right? It's this classic. It happens all the time. Seriously. So if you're jumping in on these days here, and by the way, people are, because otherwise it couldn't trade there. You're in a bunch of trouble, I believe. You've got to be very careful. And you'll find these are the people who are beginners that are jumping in here. You haven't got experienced traders jumping in here. Look, don't get me wrong, there's obviously a handful that are. Don't get me wrong, right? Sometimes with small caps, there's just believers, right? You usually find that it is the harder it rises, the harder it falls. I mean, that's fairly obvious to say, but there's usually what you call a mean reversion. Right? There's different names from it, but that's what I call it, a mean reversion, where you go back to this kind of underlying trend that's in play. Right? So what I want to do is just run through technical analysis a little bit more. Okay. I've really hyped up how important it is tonight, and I think it's only fair that I kind of describe a few principles to you. By no means is this going to be a rigorous rundown of technical analysis. I believe that we've actually done a couple of those. You can find those on our YouTube channel, a bit more rigorous than what I'm running through tonight. We do run a paid course, right, that goes for 2 days that will really get into technical analysis. We'll show you how to pick direction. We'll give you a set of trading rules, that type of thing. And that takes like, almost 2 days to teach. And then we give you, 2 months of online training. So, I mean, you don't learn this stuff in one webcast, but to give you an idea of what technical analysis is about is you can see on your screen, there's a few basic principles there. And I think it's, you can go deeper than this, obviously, as I keep saying, but ultimately this is what technical analysis is. It comes down to trends and counter trends, support and resistance levels, right? Entry signals, exit signals, technical patterns, which are also mathematical indicators, essentially, right? Now, this is what a chart looks like, right? Sometimes those charts can look different. They can be colored, they can be candlesticks. Some of you might be aware of candlesticks. Maybe some of you are only used to like line charts, right? Line charts aren't very good for technical analysis because it only shows one piece of data, which is the closing price, right? This shows a lot more data. Candlesticks show a lot more data, and that's really important to us because that's what we're studying, right? So this is this is called a OHLC chart. OHLC, which stands for open high, low close. So it shows the open of the day, the high that the stock is traded at, the low that the stock is traded at, and the close that the stock is traded at. And in this case, each bar represents 1 day of trading. So it only has Monday to Friday because that's when the market's open. It doesn't have the weekends, of course. You can, of course, have one bar represent something else, like perhaps 1 week or 1 month, where the open would be what the stock opened at on the Monday, the highest it traded at during that week, and the lowest it traded at during that week, and the close of the share price on the Friday evening at 4 o'clock. Right? So 1 bar could represent 1 week. 1 bar could represent 1 month. Typically, as traders, we focus on intraday charts, which is like 1 minute to 5 minute to 10 minute to 20-minute charts. And people have their preferences, of course, and mainly, if not most of the time, right, daily charts where 1 bar represents 1 day. You can see I'm getting pretty basic here, right? Now, this is a color chart. Now, you can obviously guess what green is. You can guess what red is, right? I just ran through this, sorry. Now, sorry, I was too fast there. So again, you've got the open on the left, right? Because time goes from left to right, typically on charts. You've got the high, you've got the low, and you've got the closing price or the current share price. All right, now resistance and support, fairly important things. Like the basic, essentially resistance and support are the backbone of technical analysis. People don't realize it, I don't think, but this is ultimately the vast majority of technical analysis. And you can disagree with me if you want, but I believe that. Resistance is when selling comes in after reaching a certain price point. So as you can see, the stock goes up and then it comes down. Why does it come down? You'll actually never know. When you read the news and they're like, oh, the market's fallen because of this, they don't actually know that. You haven't asked every single person who sold something why they sold it. So you can't know why something falls, but you can have a pretty good idea. When the market crashed last March, probably because of COVID, yeah? You can have but you never actually really know. So for some reason, the share price goes up, reaches that particular point, and then it falls. And it could be because it got to that point. Support is the same. It's just the opposite, right? Buying comes in after reaching a certain point. So it sells and sells and sells and sells. It reaches a point where the stock is just too cheap and it starts rallying again. Okay. And it goes without saying that these types of resistance and support levels are everywhere, aren't they? Right? They're going to be everywhere. The key point is actually looking for ones that have multiple touch points where the stock has reversed on multiple times. So that's support and resistance. We're getting to the next really important part of technical analysis, which is trend analysis. And I'm going to be honest with you, there's as a beginner, right? A lot of people just do trend trading, and that's actually, in my opinion, not a bad idea, especially if you're self-taught. That actually reminds me, another kind of rookie mistake is this idea of self-education or going it alone. I think you either do one or the other, and you certainly don't do both. If you're going to self-educate, then when you're ready to start trading with real money, have an advisor like myself or my colleagues that you can speak to and place trades through and have someone to check you. Cool? The other side is if you're going to do an education course with us, then you're getting educated properly, you're getting coached, you're getting mentored. And then if you want to go off and trade by yourself, totally fine, because you've actually got the good, strong foundations. The dangerous part for a trader is to self-educate by doing these types of webcasts, reading some books, right? Getting a few trade recos, and then going and placing those trades online by themselves, never talking to anyone. That's a combination for disaster, in my opinion. It's ironically the combination that most people go through before they realize that they can't do it. It's a very expensive lesson to learn. And it sounds self-serving, right? It sounds self-serving, me saying you should do education or have an advisor because that's the service I provide. But if you think about it, that's what makes a business. I'm not going to provide you a service I don't think is going to be helpful for you. There's a reason my business is successful, and it's because I provide services that people utilize, need, and help them. So just have a think about that. Now, investing again is different. You want to go buy some stock, then yeah, I mean, ultimately over 20 years, you're probably going to be all right, aren't you? Probably. Sorry for that segue, but I did actually want to cover that tonight, and I felt like that was an all right point. Now, an uptrend is when a company's share price moves in an upward direction. I mean, that the name describes what it does. But an uptrend is actually defined by successive peaks and troughs. So an uptrend, you can see these are peaks. They're like apexes, right? And these are troughs, right? Or trenches, or whatever you want to call them, right? So an uptrend is defined by higher peaks and higher troughs. Share price is down here. Now it's up here. It's gone up. Excuse me. A counter trend is a movement that is against the direction of the underlying trend, right? So what that means is that if the trend is up and the share price is falling over a certain period of time, that is considered a counter trend because it is going against the underlying trend. It's counter the underlying trend, right? That makes sense. All right. If we were to give a real life example, this is Oz Minerals, or a pretty old chart of Oz Minerals, mind you. And you can see there's an uptrend, right? We're seeing consecutive high peaks and higher troughs, right? In the short term, we're seeing it. In the long term, we're seeing it. It's an uptrend, right? Now, the line that I've drawn here is called an uptrend line. And there is a difference. An uptrend is higher peaks and higher troughs. An uptrend line tries to connect the troughs of the uptrend, right? I'm not drawing the uptrend line through the middle of the stock like some people do. I don't believe that's a good idea, albeit I think there's a time and a place for it, believe it or not. But ultimately, when we draw trend lines, they should be underneath the stock because they actually keep the stock rising rather than, they act as a support level. It's just that support level has a gradient, okay? The lines that are coming down are the counter trends or the counter trend lines, right? Because they're moving against the underlying trend. Okay, and this is just terminology. This is just terminology, okay? Now, a downtrend is just the opposite, right? It's when you start seeing lower peaks and lower troughs. And a counter trend against the downtrend would be any kind of consistent upward movement against the underlying downtrend, right? It's just the opposite. So this is a chart of AGL that I actually grabbed today. So this is like really up to date. It was a very busy trading day for us. So I actually didn't have a lot of time to prepare, to be honest. But this is a current example of AGL. This is the downtrend line. That's fairly obvious, right? We're seeing lower peaks and lower troughs. And, I'm connecting the peaks for the most part there. It's keeping the pressure down. It's forcing AGL lower. And these are the counter trends. So you've got a pretty strong counter trend here that lasted a while, formed a pennant pattern, if you're familiar with that. Formed another pennant pattern. And right now we're also forming another pennant pattern. Question is, will AGL break lower and continue down towards $9? Or will it break higher or will it break higher and head towards perhaps 12? And the answer to that question may not be as simple as you think, because at some point the trend will change, won't it? Either that or AGL goes bust. AGL goes to zero. Now there's talks of AGL splitting, right? I'm pretty sure they announced that, but that's not really the point. The point from a technical perspective is that trends generally change. And the saying goes, the trend is your friend. And as I recently found out, I'm ashamed to say, the saying goes, the trend is your friend until the bend at the end. It's like the saying, great minds think alike. And the other side of that is fools never differ. So the trend is your friend until the bend in the end. The trend will change eventually. Just be mindful of that. But generally speaking, things go in the direction of the underlying trend because it's fairly self-evident, I would say. So this is, the other thing. This is another example, right? And I want to show you a defined market range. It's a bit of a technical pattern as well. But you can see that this is trading in an uptrend, right? Obviously it's trading in an uptrend, but from a technical perspective, right, by definition, we are seeing consecutive higher peaks and higher troughs. And that's really important because it actually strengthens the trend. Remember how I showed you that small cap chart before, that stock of BRN? Remember that? Where it just kind of smashed higher? That usually leads to a big fall. It's not sustainable, is it? Something that is just skyrocketing isn't sustainable. I think we can all agree with that. So we actually do want to see pullbacks. We want to see retracements. It's a strengthening of the underlying trend. You can see there's the uptrend line. Now I've also labeled that support because an uptrend line, as I said earlier, is basically a support level. It just has a gradient, has a slope. There's a resistance level. Now, technically, we don't typically draw trends like that unless we're trying to draw a channel or a bit of a market range. Okay, so that can act as a bit of a target in some ways from a broader perspective. There's a level of support. Now, why did I draw that level of support in? Not only is it a clear turnaround here, so the stock was falling, falling. Now there's some buying support, right, or buying power, right? But the reason why I like this support so much is because historically it's acted as support as well. You could argue that it held here, albeit it did come down here. It actually closed here and then opened there. So there's a bit of support there. You can see there's a bit of support here, a bit of support here, a bit of support here. And interestingly enough, a bit of resistance there in the past as well. So support and resistance can swap roles. And again, remember how I said earlier, it's just terminology. Whether it's called support or whether it's called resistance purely just comes down to where the stock is in relation to the line. Is the share price above the $52 level? If the answer is yes, which it is, it's a 53, then it's a support level. If the share price was at $51 though, it'd be a resistance level like it was back here. So support and resistance can swap roles. And the type of support and resistance that we're looking for are ones that have played out consistently in the past, that have several touch points, like this $52 level. And it's also good because it's a nice whole number. Markets like whole numbers, I find. Now, that's all well and good, right? The question is, okay, well, what about entry signals? Do I get in today? Do I get in tomorrow? Should I have gotten in yesterday? Or should I not even get in at all? That can kind of come down to entry signals. Now, entry signals is one of those things where it can be, again, really, really tight. It can be fairly loose. There's clients I know who won't do a bullish trade on a strong bullish day. I'll let that sink in for a moment. I'll let clients. There's clients that won't do a bullish trade unless there's a strong bullish day. So the market, it takes all sorts, right? It's like licorice. So the typical kind of entry signal in this case is a strong bullish day, right? So you can see that the close is higher than the open, right? Fairly high above the open, so that makes it a bullish day. It opened down here, and now it's trading up here. Okay. That's what you call a bullish day. That's a good start to an entry signal. But we also like the fact that the buying has remained for more than one day. So you can see that the high of the day is higher than the previous day, and the low of the day is higher than the low of the previous day as well. We like that. That shows consistent buying power, right? Sustained strength, if you will. So that's a type of entry signal. Now, after we're happy with the trade, we go, yep, this is looking pretty good for a short-term bullish trade. The only other thing that we like to do is confirm our view. And the way that we typically do that is through technical indicators. Now, technical indicators are mathematical formulas represented almost always as a graph, right? Now, a graph is a visual thing, right? It's a graph, right? In this case, this is what you call the stochastic oscillators. It's a pretty big word for something that's, I would say, fairly simple. What's the maths behind these? I don't want to get into it. That's partly because I don't know. I understand them somewhat, I would say, mathematically, but ultimately, I know how to use them. Is that okay? So the stochastics are a confirmation tool. And this brings me to the next point of another rookie mistake, right? I told you I'd be kind of dotting these throughout the presentation. Another common rookie mistake is to rely on these technical indicators. And there's a whole bunch of them out there. RSI is another, also known as the relative strength index. I used to use that a lot. The MACD, right? Some of you would have heard of. Elliott waves, right? Is kind of one. What's another one? Moving averages. I use those all the time. I love those. I always have moving averages on. I have the 50, 100, and 200. But some people go kind of nuts. They use like the 7 as well. And yeah. What's another one? Exponential moving average, obviously, is a variant of the moving average. There's a whole bunch of them, right? And because they are, really interesting, rookie traders will use them as the foundation of their decision making, which is the wrong move. Trust me. So someone will go to me. So I'll go, oh, why did you enter that trade? What attracted you to that stock? And they'll say, oh, it was, it's 10% below its moving average, the 200. And I go, oh, okay, what else? And they go, well, that's about it. So their only analysis is really built around the technical indicators. And it's just because it's easy that way, right? But unfortunately, things that are easy in life probably aren't worth it too much, right? I don't know if that's right, but that feels right, right? Maybe a better way of saying it, things that are hard, things that are worth it are hard to get, I would say, maybe. So you can't just rely on these technical indicators, even though they're pretty cool, right? They're actually confirmation tools. And the reason why I'm talking about them at the end of my analysis is because that's when you should look at them. The bulk of your analysis needs to be on uptrend lines, downtrend lines, support and resistance, counter trend, market ranges, entry signals, exit signals, all the other stuff that I just kind of ran through, plus more, right, that I haven't gone through. And then at the end, you confirm them with your indicators. Now, the stochastics down here, right, we like to use, and you can use the stochastics in a very, very light way, which we teach our clients. And you can go a lot deeper into stochastic analysis, particularly when it comes to divergence, right? And some of you online who are proficient, you'll know what I'm talking about. But it's not something we actually even teach to beginners because we're just getting way too into it. But something that you can learn a bit later on, right? So divergence is another one. But generally speaking, what we teach to beginners, what the stochastics can be immediately used for, which is fairly easy to understand, is you've got this overbought area up the top here, you've got an oversold area down the bottom here, and if they're in the oversold area, as the name would describe to you, the stock is relatively oversold in the short term, right? So when you see both lines pointing up and coming out of the oversold area, it is a bullish signal. Equally, if they're in the overbought signal up here, can you see how they're up here in over the overbought area, just all the way up here? And they're coming out, that can be a bearish sign. Now, see how it didn't actually fall that much, did it? It went sideways for a bit, then fell. So if you only did that analysis, then you'd be in trouble. Yeah, I mean, even so, you could also do all the right things and still be in trouble. That's the nature of trading, right? But yes, my point is that all your analysis shouldn't be based on this stuff. It's a fairly common mistake. The stochastic can also gauge momentum. So you can see there were really, really big days there. Stochastics widened. That can show an increase in momentum as well. And again, you use them for divergence, but I don't have an example of that, and it starts getting pretty complicated. You can do a whole, half-hour video on that alone. All right. Now that you want to do a bullish trade, obviously the next step is to plan your trade, right? So just to recap, right? At the end, you want to consider your fundamentals. Is it going to report tomorrow? What's the broader market looking like? Is it a healthy stock? I'm not going to get into fundamentals today, but yeah, consider your fundamentals, and then plan your trade. Now, there's two ways to trade in our opinion, right? You can just buy and sell the stock. That's kind of fine, if not very, very, very limiting. Or you can trade derivatives. Now, should you go out there and start trading derivatives tomorrow? Nope, you certainly shouldn't. But I do believe anyone who wants to generate an income stream from the market, anyone who wants to trade on a fairly consistent basis, should learn how to trade derivatives. And I said learn. I didn't say just go out there and start trading. I really want to emphasize that, because derivatives allow you to do some, pretty cool things, right? They give you access to leverage, and they give you access to different strategies. And what I mean by strategies is different ways to trade. So, for example, what's the most common strategy out there for trading, do you think? It is buy low and sell high. When I was younger, because I'm still young, when I was younger, I had a friend tell me, he's like, hey, you know what's really interesting about the market? When the stock goes down here, you buy it, right? And then you wait for it to go up to this point here, and then you sell it. And then you wait for it to fall again, and then you buy it again, and then you wait for it to go up again, and then you sell it. This guy just like invented the wheel. Basically taught himself buy low, sell high. It was very funny. It was a very funny moment in time. Obviously, it's not that simple, right? But it's the only strategy that a lot of people use: buy low, sell high. You certainly don't want to do the opposite to that. If you've got a lot of money, sometimes I don't think anyone online here tonight will have access to short selling. Typically, you have to have a lot of money. Put it this way, short selling as a retailer is really, in my opinion, really dumb. There's just way better ways to short the market, short stock. It's certainly not short selling. It's just a really dumb way to do it if you're a retail trader. So instead, what you can do is you can use derivatives. You can trade bullish strategies, you can trade bearish strategies, right? And you've got access to leverage. The type of derivatives that we like to trade are mini warrants and options. And you trade those through the ASX, you trade those through the exchange, right? And the reason why I've said that, reason why I've highlighted that to you tonight, is because there's derivatives that you don't trade through the exchange. And those are derivatives that you should almost certainly stay away from. Okay, so trade things that are only traded through the exchange. I would typically suggest only start with the Australian market because it's your backyard, you're protected if you're an Australian citizen. Okay, it's transparent. Australia is a highly regulated market, as I'm sure you are all very aware. We live in somewhat of a nanny state in some degrees, right? And that is a good thing in some ways because it protects you, right? You won't have your money just randomly stolen. Okay, so trade things through the ASX. Then once you get experience, you can maybe trade through other exchanges around the world, like the New York Stock Exchange, for example. There are derivatives that you can trade that aren't traded through the exchange, such as binary options. Never trade binary options. CFDs. Some of you will go, oh, you can trade CFDs through an exchange. It's true. I don't think you should trade CFDs because typically your money is on someone else's balance sheet. Halifax went under, was it last year? Or maybe it was the year ago. The COVID year last year was like a gas leak year. Like I've forgotten half of it because of COVID, but it might have been 2 years ago. Halifax went under. That took a lot of people's money with them because your money's on their balance sheet. So I would stay away from that as well. So we trade derivatives like mini warrants, and we trade options, and they're traded through an exchange. And what they allow us to do is, like I said, they allow us to have leverage, which means that we can use less money to make more money, right? But the opposite of that is we can lose more money as well. And we have access to strategies that allow us to trade bullish markets. It allows us to trade bearish markets. And in the unique case of options, it allows us to trade sideways markets as well as multiple direction strategies. So, for example, the market, as in the XJO, as in the ASX 200, the market, the Australian market, has been tracking sideways for a very long time as a whole. We had option strategies where we capitalized on that several times throughout that period. You can't do that with stock. You can't even do that with mini warrants. Does that mean, you should go out there and trade options tomorrow? Again, absolutely not. The flexibility comes complexity, right? With flexibility comes complexity. So these things you can't learn overnight, and they take time to learn for certain, right? If any of you are learning options, you'll know exactly what I'm talking about. I run a webcast every Wednesday just to teach options to my clients live. And if you can't make that session, it's recorded, obviously. But the clients that are learning options, I teach every Wednesday. They do a 2-day course. They get, there's a bunch of online training. There's a whole bunch of videos that we give our clients just to teach options all by itself, right? So they're complicated, but they're flexible, and they allow you to trade any market condition you can think of, and you can trade multi-direction strategies. So for example, we've got a bull put right now on NAB that we've suggested to our client as a recommendation, right? We just need NAB to stay above $26 between now and, between a few weeks ago and the 15th of April. And they're already in a really good profit, right? And what has NAB done for the past 2-3 weeks? It's just gone sideways, and you can't make money from that by trading mini warrants or shares. Certainly not shares. Right, so options are really cool from that perspective, but they're more of an advanced tool. If you're a beginner, start with mini warrants. And the good thing about mini warrants is that they're capped risk. You can't possibly enter a trade where you have unlimited risk, which you can with options if you're a novice. I would never suggest doing so, but you can accidentally do it. And so they're capped risk with mini warrants. They have inbuilt stops. I'm going to run through this more in a moment. They have choices of leverage, and you can do bullish strategies and bearish strategies fairly easily. And what's awesome about them, if you're already got a ComSec account, for example, or some kind of trading account with someone, you can just go start trading straight away. You could go do it tomorrow. Again, I don't suggest it, but it's super easy to have access to them. Options, on the other hand, I think brokers will kind of like test you first to see if they should allow you to trade them, right? Now, I just want to give you an example of what leverage is, because maybe some of you don't know what it is. And look, leverage is one of those things that you really need to respect, but yeah, I mean, high risk, high reward kind of thing. If you don't understand what you're doing, it's like driving a car or walking. I love this analogy, right? You might not like it, but I really like it. Walking down the street doesn't take a lot of learning. You kind of learn it when you're a child, right? Most of us do anyway. So to get from A to B, you can walk it. It's simple, right? No problem. And very easy to understand. But it's slow, isn't it? Right? How do you get from A to B quicker? Well, you can drive a car. Right? Driving a car is a lot more complicated though, unfortunately. And you can't just start driving cars. I mean, legally, we won't even allow you to do it. That's how dangerous it is. Right? Now, there can be life and death ramifications in not knowing how to drive properly. Obviously, there's not with options, right? Or derivatives. I don't want to suggest that. But my point is that driving a car will get you to A, B quickly. It can be very, very rewarding. But, if you don't learn how to do it, if you don't pass your driving test, if you don't have a driving instructor, if you don't have your mom or your dad or your uncle or your aunt teaching you how to drive first, holding your hand, if you don't learn how to do these things properly, then you can get hurt, right? And it's the same for trading. You can walk A to B, nothing wrong with that. Fairly simple. You can buy some shares. It's totally fine. That's your goal. We'll help you with that as well, by the way. That's awesome. And I think everyone should try to do that. But if you do want to trade, and it's not for everyone, if you want to drive that car, it's really important that you learn how to do that properly, because it can be very rewarding, but it's also inherently higher risk. Okay, so I'm just going to run through leverage. If the current share price is $32, in this case, the mini price might be $3. So you could buy some shares and pay $32 a share, or you could buy a mini warrant on that share for $3. So in this case, let's say it's BHP, even though this is not BHP. You could buy BHP shares if you wanted to, or you could buy BHP mini warrants and pay $3. If the share price goes up 50 cents, well, you've made 50 cents on each share that you bought BHP on, right? Okay. But you also earn 50 cents on each mini warrant. So mini warrants value move 1-for-1 with the share price. If BHP shares go up 50 cents, then so do the value of BHP mini longs, mini warrants. This is a mini long, by the way, not a mini short, obviously. If the share price goes up $1, then the value of the mini goes up $1.
Now, hopefully you've clued into really what the impact here is, what this actually means. For the stock, if the share price goes up 50 cents, you make 1.56%, right? You paid $32 when you entered the trade. You've made 50 cents. That's a profit of 1.56%. On the other hand, if you'd done the mini, you paid $3. The share price went up 50 cents. You actually make 16%. 50 cents of $3 is much more than 50 cents of $32. It's the same. If it goes down though, it's the same thing. Instead of losing 1.56%, you lose 16%. You can extrapolate from there, can't you? So you can use a lot less money to make a lot more money, but the risk is that if the trade goes against you, you can also lose more. Trust me, there's no free lunches in this market. There's no free lunches. There's no risk-free. Well, there is a couple of risk-free strategies, but they're negligible, technically. But ultimately, for all sakes and purposes, there's no free lunches, there's no free money on this market. You want to be able to make money faster? Then be prepared that you can also lose money faster as well. That's a very, very real possibility. And don't let anyone tell you otherwise. They've got some secret that makes lots of money very quickly. Be very skeptical, very skeptical. The only way to make money from this market is to put effort in, to practice, be consistent, be disciplined. And yeah, that's a lot of effort. Now, the cool thing about mini warrants, as I mentioned to you earlier, is that you can trade them on BHP, right? That's a stock. It's a fairly household name, isn't it? Right? It's a blue chip share. But you can actually also trade them on a bunch of currencies, a bunch of commodities, and a bunch of world futures all through our market. How cool is that? So you can trade them on household names. But let's say, you thought the Australian dollar was going to go up, which, against the US dollar, I do believe. I actually think that's a good trade. It's another tip for you right now. Mini long on the Australian dollar might not be today's, not the best entry, might not even be tomorrow. I can't actually tell you when that's going to be, but it's going to be soon, I believe. A mini long on the Australian dollar versus the US dollar. You can do that. And you don't need a Forex trading account. You don't need to go open up a random trading account with someone that you don't know or don't trust. You can, if you have a ComSec account or you have a trading account with us, you can not right now because the market's not open, but tomorrow morning at 10 a.m. when the market's open, you can buy a mini long on the Australian dollar versus US dollar, or a mini short if you want to short it for some reason, if you're crazy. You can do that. You can do it also on commodities. So, people have been pretty bullish gold, albeit hasn't been doing well over the last 6 months, I would say. People have been pretty bullish silver as well. You can go and buy the physical asset, and bear in your backyard. But that's, I would say, more of an investment mechanism, not a trading one. But if you did want to trade the futures of gold and silver, you want to trade the futures of oil or copper, all these things have been in the news fairly regularly, then instead of opening up some futures account with someone you don't trust, in your ComSec account tomorrow morning when the market opens, you can go buy a mini long or a mini short on those things, and they're traded through the exchange. Same thing for the world futures. You want to speculate on futures of the S&P 500? You can. You don't have to have an overseas account using US American dollars, which, can be a hassle. You can do this all through your Australian trading account. I promise you. You got to know how, but you can. It's super easy. That's what I love about mini warrants. You can trade them on a whole bunch of different securities or different underlying things. Oops, sorry. And you can trade them on about 200 Australian stocks. You should recognize a lot of those stocks on your screen. A lot of them are mid to small. No, there's a lot of small caps in there as well. Yep, that's pretty cool, isn't it? Now, after you've planned your trade, right? So you might go, okay, well, I'm pretty bullish Oz Minerals, or I'm really bullish the Australian dollar versus US dollar because I've done my technical analysis, right? I'm going to do a mini long on the Australian dollar. versus US dollar. Or I'm going to do a bull call spread on, which is an option strategy on this particular stock. Or I'm going to do a buy right or something like this. The next step is to manage your risk. Now, and I'm not going to get into this tonight because if we look at the time, it's basically 8 o'clock and I do need to start finishing up and answering questions. But ultimately, you're not going to get every trade right. That's for certain. In addition, you're going to have, losing trades in a row. You're going to have a string of losses at some point. This is why, again, psychology is so important. But obviously, losing trades are part of the game. It's a cost of doing business, one might say. And risk management is just as important as the other ones because it's a fact of life, really. Okay, and that's the other thing that you need to be very aware of. You need to understand when to get out and why. You need to look for exit signals and implement stops, and to preserve and manage capital. All much, much easier said than done, for sure, but still a very big part of trading. Okay, so just to recap, if I may, should I do it? Just to recap, if I may, those course numbers aren't actually correct at all. Ignore the 24th and 25th of October. I thought I had changed them on my slides, but I haven't. The next course isn't until later, but we can go through that. You can give me a call if you want to know if you are, and the next webcast, I'll talk a little bit more about that. But more importantly, you can speak to Jared and he can run you through our courses. But we do run a beginner's course, and I'm just bringing up the next dates for that now as I talk. But just to recap, if I may, the 3 things that you need to master in order to be a successful trader is the ability to pick direction, right? It makes sense to have a bunch of strategies that you can utilize, right? You can go long, you can go short, right? You can go bullish strategies, bearish strategies, sideward strategies, bullish and sideward strategies, bearish and sideward strategies. There is a strategy that we like to use during reporting season, which is a bullish and bearish strategy. So it doesn't matter if the stock goes up or down, you make money. The problem is that if it goes sideways, so you need a lot of bullish movement or you need a lot of bearish movement. I'm talking 4 or 5% in a very short period of time. And when does a stock, I wonder, when does a stock move a lot? Maybe around its half-year reports, maybe around its full-year reports. Quite often we can see 4, 5, 6, 7, 8, 10, 12, 15% movements on a stock the day it reports or the day following the days following the report. And so we implement a strategy with options where we make money if that happens on the upside or the downside. What we don't want to see where we lose money is if the stock does nothing. What are the chances of the stock doing nothing on a reporting day? It happens, by the way, it does happen. I just don't think it's a very big chance. So you want to have strategies that allow you to trade consistently, that allow you, if you're trying to generate an income stream, that makes sense, and to trade different market conditions. And you also want to, have good risk management, right? What brings all that together is a set of trading rules. Okay. And again, as I said to you earlier at the very start of the presentation, if there's anything that you take away from tonight, it's basically that. You've got you need the ability to pick direction. You need to have some strategies. You need to manage your risk. And to bring all that together in context, you need a set of trading rules. In terms of rookie mistakes, I ran through how people rely on technical indicators too much, how people don't have trading rules or how people don't follow their trading rules. These are fairly common rookie mistakes. And probably the biggest rookie mistake of all time is that new traders believe for some reason that self-educating and then trading by yourself is a recipe for success. I don't know if I don't know how people believe that. I don't understand why that makes sense to people. If you wanted to be, if you wanted to be good at something that's complicated, watching a bunch of YouTube videos, I just don't understand how people kind of get that into their mind, right? You don't have to do a course with us. It doesn't bother me. But if you decide to go down the path of self-education, just make sure you have an advisor or a mentor that can help you with the trades that you actually apply in the live market. That makes sense, doesn't it? Now, the next actual option, beginner's course that we're running, where we teach you all the things that that I've just kind of run through tonight, much more rigorous detail. is the 1st of May. With all our courses, we only take in a small group of people, right? We only take in like 10 face-to-face in our boardroom, in our office. If you know, with COVID and everything, there is live stream available if you prefer to do that, but most people I know prefer to do face-to-face. And they book out, I'd say usually, there's still some spots for it. I think we've got like 5 people booked in, so it's about half full. Right, and we're at the start of April. So they book out fairly quickly. Yeah. So yeah, that's a course that we run, and we do run an options course, and we have a couple others as well. But again, I didn't really want to get into that too heavily tonight. Glenn, you are, by the way, we're at the end of the presentation, as you can probably tell. The next webcast, the second part, is going to be on next Thursday, but it's going to be at 1 p.m. So we're actually going to do it during the day. And what I want you guys to do right now is type in any stocks you want us to look at. Right? So let's say your mate at the pub or someone said you should buy Afterpay, for example. Right? It's a fairly common one. Type that in if you want us to look at it. We'll do that. So what we do from Monday to Friday, right, when the market's open, any day that the market is open, unless, you know, like we didn't run one on Tuesday if we actually moved office, or if someone's like very ill, you know, they might not run theirs. But for the most part, every day without fail, Monday to Friday, when the market's open, we run a webcast from 12 to 1, right? Which is why we can't actually do next Thursdays at 12 o'clock, because we'll be running one already. And we run them for our clients, right? That 12 to 1 webcast, we go through the market and we look for trades as a group, right? It's very similar to what we're doing right now, except instead of me teaching you a whole bunch of education, it's one of the advisors running through the market and looking for trades as a group, talking about trades that you might be in, talking about recommendations that are still open, and talking about new possible trading ideas as well. And we basically use the rules that you've been taught, albeit we might adjust them. The Wednesday webcast I actually run every Wednesday. I spend the first half going through the market looking for trades. Then I spend the second half actually going through options education. My colleague Ben, fantastic trainer, a fantastic advisor, he does the same thing, except the second half of his Friday webcast is spent on basic education, essentially. But he will spend a lot more time going through the market and applying that stuff live. And then the Monday, Tuesday, and Thursday webcasts are owned by each of the other advisors, and they just go through the market and look for trades. And each of them have their own kind of specialty, have their own personality, have their own strengths. You get a real diverse opinion on what the market's doing that day and for trading ideas. So we're going to actually try and do that with you guys next Thursday at 1 p.m., which is why we have to run it at 1, because 1 p.m. is when the market's open. It's also in the afternoon when we think, you know, you should kind of be trading. If you're going to enter trades. There's exceptions to that rule, obviously, but generally speaking, they say that amateurs get in the morning and professionals get in the afternoon. Again, there's exceptions to that rule, but that's why we're doing the afternoon, not the morning. So please join us. You've been automatically enrolled for it. If there's any stocks you want us to look at in advance, type into the chat now. I can see that people have already done that, which is awesome. 3DP, RHY, FMG. FMG is a personal favorite of mine. And any others that you want, if you think of them on the day, we'll also do that. And yeah, we'll go through that. All right. Again, if you feel like you want to watch the recording of this webcast, you can. I encourage my clients to watch the education stuff if they're still learning options before they attend my next webcast. So I'll say the same thing applies here. If you're new and you're going to attend the next Thursday webcast, re-watch the education stuff from this one. You can skip through my ramblings, right? That's fine. And just get to the guts of it before you watch the next one, because that'll help you refresh. You'll have like a running start. And we're going to try and apply a lot of the principles in that session as well that we taught tonight. All right, guys, thanks very much for joining me tonight. I hope you really enjoyed it. I really enjoyed it. I think I've answered all the questions. Let me just go back and double check. So beginner course may win, however. One is how much is the 2-day course you mentioned from Glenn? Glenn, you asked that again. Also beginner course in May, dollars when, how. So the beginners course that we run, I don't usually like talking about price unless I can sit here and tell you how much value there is, which I think is fair enough, right? If I just tell you the price of something, and then I don't tell you why it's so good, then you're judging it based on price alone, which I don't think is fair. But I will say it's just under $2,000, but that nets you 2 months of online training. You have your own personal trainer. It's a 2-day full workshop in our boardroom. It's fully catered for. We provide you with manuals. We don't make money from our courses, by the way. Like, we break even, essentially. They're a stepping stone, as I mentioned earlier. You get access to all the webcasts. We'll give you trade recommendation, market data, trading platform that we use, right? That gives you full charting functionality. I mean, there's so many resources that we give you to help teach you, and you get your own personal mentor who's there to really answer all your questions. We run a paper trading competition. The winner wins a prize after 2 months, right? Yeah, a lot of resources given to you. And it's a extremely good price. We used to charge twice that, and we used to take in like 40 people, but we didn't want to do that anymore. Rather focus on the trading, bring in a small amount of people, focus on you as an individual, and give you as much support as possible to turn you into a good trader. If we can turn you into a good trader, if we can help you become successful, then you're likely going to stay a client of ours for the long term, which is what we're all about, is retention rather than acquisition. And you're more likely to continue to use our services. That's kind of our business model. So that answers your question on price. How you can do it face-to-face in our boardroom. Because of COVID, we understand that a lot of people aren't wanting to travel, so you can do the live stream. The person you're taught by, his name is Carlo Castellano. He is the person who actually started the business. He's been teaching and trading for over 25 years. He is, he's basically retired, actually. He retired 4 or 5 years ago, and he just sits at home. I think he does, works on his motorbikes, trades, trades a lot. He still gives trade ideas to us. Like, if he goes through the market doing his own trading, he'll say, hey, there's this Suncorp trade that fits my rules. I'll put it out to the students. So he still has a strong foot in the door. He still runs the education, but basically just trades from home. So he's the person who taught me. He was my mentor in a lot of ways. And he's the reason why I'm able to teach and trade today. So anyway, that's the beginners course. Like I said, we also run an options course as well. I didn't really want to spend tonight talking about it, but it's after 12. After 8, it's 12 past 8. So we can talk about whatever we want from now. I do kind of want to finish up sooner rather than later. I myself have not had dinner. I kid you not. So I'm a little bit hungry. I appreciate all of you jumping on tonight and kind of getting involved and asking questions. All those stocks I'll make sure to take note of. We'll look at them in the next Thursday webcast. Hopefully you can join us. Thanks very much. Good luck and happy trading, as we say here. Some of you online, I'll speak to you before the next Thursday, but if I don't, as I said, good luck, happy trading, and I'll see you all on then. Thanks, guys.